Level 1. Overdraft and negative balance. Your account is in the red, maybe by $4, maybe by 400. The number barely matters because the mechanism that responds to it doesn't scale with severity. It just activates. The overdraft fee hits within hours, $35 at most institutions. Some banks charge it per transaction, which means if 3 small purchases go through while your account is negative, you owe $105 in fees, on top of whatever deficit you were already carrying. The logic of this system is almost elegant in its brutality. If you had money, you wouldn't be overdrawn. But because you don't have money, you now have even less of it. You try to pay at the pump. Card declined. You try again. Declined again. There's a line behind you. You're doing mental math as fast as you can. Did yesterday's transfer go through? Did the paycheck land? And the card is still declining, and people are waiting, and time stretches in a way that only shame can produce. This is what financial stress actually looks like in real life. Not dramatic, not cinematic. Just a card declined at a gas station while you try to piece together your account history in your head. The bank offers you overdraft protection. In practice, here's what that means. Instead of declining the transaction, the bank covers it and charges you $35 for the service of sparing you the public humiliation at the register. Some banks have reduced these fees under regulatory pressure, most haven't, and the ones that keep them collect them disproportionately from the people who can least afford to pay. American banks collected over $7 billion in overdraft fees in a single year. The majority of that money came from a small number of chronically overdrawn accounts. The same people, paying over and over again, for the privilege of being poor in a system that charges you for it. At this level, you don't get a credit card, no loan, no flexibility, no patience, no phone call from someone who actually wants to help. What you get is entirely automated, a fee assessed by a system that doesn't know your name, that doesn't know you were overdrawn because your paycheck was delayed by 2 days, that doesn't know the $47 charge was a gym membership you forgot to cancel 6 months ago. The system knows exactly one thing about you. Your balance is negative. Everything else follows from that. At this level, you are not a customer. You are a loss the bank is trying to recover. And the worst part, the system wasn't even designed to destroy you. It was just designed to be profitable. And for some people, those two things are exactly the same. Level 2. Low balance. You pulled the account back from the negative. You have $200, sometimes $400, occasionally $600, right before rent hits, and it drops all the way back down again. You are not overdrawn. You are something slightly better than overdrawn, which is to say, you exist in the category of accounts the bank services, but does not particularly care about. Then the monthly maintenance fee arrives, $12, sometimes $15, automatically withdrawn because your average daily balance didn't meet the minimum requirement. The minimum is usually $1,500, sometimes $500, depending on the institution. If you had $1,500 sitting untouched in your checking account, the fee would vanish. But because you don't, it stays. Every single month, you are paying a recurring charge to store your own money in an account that was supposed to help you save it. The account itself is basic. Checking or savings, no special rates, because your balance is too low to qualify for the tiered structure. You're earning 0.01% annually on whatever sits in there. That is not a typo, 0.01%. Meanwhile, the bank is lending that exact money out at 7 to 24%, depending on the product. The spread between what they pay you and what they earn from your deposits is how banking works at every level. At this level, you are simply not large enough for them to compete for your business. You are a depositor. You are not a client. You try to apply for a credit card. You might get approved for a secured card, which means you have to deposit money up front as collateral against your own credit limit. Read that again slowly. You deposit your money. The bank holds it. Then they lend it back to you and charge you interest for the privilege. This is completely legal. This is considered normal. And this is how credit gets built when you're starting at the bottom of the tier system, by paying a bank to borrow access to your own money. The service you receive at this level is not hostile. It is something harder to fight than hostile. It is indifferent. The teller is polite. The app works fine. If you call with a problem, you wait on hold, then speak to someone reading from a script who can resolve standard issues and escalate everything else to a person you will never actually reach. There is no relationship here. There is a transaction. You need basic banking services. They provide them. That is the full extent of it. You are a number at this level. Specifically, you are a small number. And the bank's interest in small numbers is purely algorithmic. No one reviewed your account. No one noticed the fee hit on the same day your paycheck was 3 days late. No one flagged that you've been a customer for 4 years without a single missed payment. The system didn't notice because the system wasn't built to notice. It was built to process. And at this balance, processing you costs more than you're worth. That's not an insult. It's just math. Their math, not yours. Level 3. Stable income. Something shifts. Not dramatically, not overnight, but the account starts to look different. And the bank starts to treat you differently. You land a real job, or the one you had starts paying what it should. Your direct deposit is now $3,200 a month, arriving every 2 weeks like clockwork. You didn't call the bank to tell them. You didn't fill out a form. The algorithm noticed on its own, because that's what algorithms do. They watch. And when the pattern of your account moves from irregular and low to consistent and moderate, the system quietly reassigns you. The credit card offers start showing up, not the secured card that required you to deposit your own money as collateral. Actual credit cards, with actual credit limits, $2,000, maybe $3,500. The interest rates are still high, 22 to 26%, because your credit history is short and the bank is still pricing you as a risk. But the door's open now. The same institution that had absolutely nothing to offer you 6 months ago is now mailing you things, showing you banners inside the app, calling you a valued customer in the subject line of emails you didn't sign up for. You haven't changed. Your income changed. And that is the only thing that was ever being measured. You apply for a small personal loan. $5,000, car repair, something real, something necessary. It gets approved in 48 hours. The rate is 11%, which isn't great, but it's manageable. More importantly, it worked. You needed something. You applied. You were approved. For the first time, the bank functioned the way banks are supposed to function in the stories people tell about banks. The machine processed you, and the output was yes instead of nothing. That matters more than it should, because you remember when the output was always nothing. The monthly maintenance fee has likely disappeared because your direct deposit now qualifies you for a fee waiver. This is a small thing that feels disproportionately large because you paid those fees long enough that their absence registers like a weight lifted. The account is costing you nothing to maintain. You're keeping your own money without paying for the privilege of doing so. That used to not be true. Now it is. And you notice. You are a customer now. Recognized. Serviceable. Profitable. The bank wants to retain you because you are generating revenue through your card usage, your loan interest, your growing balance that they're lending out at a spread you'll never see. You matter to them the way any customer matters to any business. As long as you're producing, you're worth keeping. The moment you're not, you'd be replaced without a second thought and without ceremony. This is not cynicism. This is just the honest version of what customer loyalty means at this level. You are valued, conditionally, algorithmically, precisely as much as your direct deposit says you should be, and not $1 more. Level 4, growing savings. You didn't win anything. You didn't get lucky. You didn't find a shortcut or stumble into an inheritance. You were just consistent, quietly, unglamorously consistent, over several ordinary years. And that consistency, compounded, has started to change something. The savings account has $18,000 in it. The investment account has another 22. The credit card gets paid in full every month, which means that 24% interest rate is completely irrelevant to your life. You never carry a balance. The rate exists. It just doesn't apply to you anymore. The credit limit increases start happening without you asking. You log into the app one morning and the limit has moved from $4,000 to $9,500. A few months later, $14,000. You didn't request this. You didn't negotiate. The bank's risk model simply looked at your history, on-time payments, low utilization, 0 defaults, and extended you more rope because your record shows you don't need it. This is how the system rewards discipline, not with praise, not with a phone call, with a quiet number update inside an app. More access, offered automatically to the person who has already proven they don't need to use it. The loan rates get better. When you finance a car this time, the bank offers you 6.8% instead of 11%. Not because they like you more as a person, not because you've built a relationship with anyone there, but because your credit score and your asset profile have shifted the risk calculation in your favor. The price of money is lower for you now. And that sentence deserves a moment, because most people never stop to think about what it actually means. Wealthy people don't just have more money, they pay less for the same money. Lower rates on mortgages, lower rates on car loans, lower rates on business financing. The gap between what a person at level 2 pays to borrow and what a person at level 4 pays on the exact same product can be 8, 10, 12 percentage points. That difference, compounded over a lifetime of borrowing, is itself a form of wealth transfer, from the people who can least afford high rates to the people who least need low ones. Better rates mean you keep more capital grows faster, faster growth widens the gap. The system begins to tilt in your favor, slowly, quietly, at the level of basis points and approval odds. And it does so not because you deserve it more than anyone else, but because the numbers say you're safer. You're becoming valuable to this institution, not precious, not a priority, but valuable enough that they would prefer to keep you and would make a real offer to do so if you threaten to leave. Walk into a branch and mention you're thinking about moving your account somewhere else. Someone will try to retain you. They will offer something, a rate, a fee waiver, a product upgrade. That is a fundamentally different experience from the automated silence of level 2, where leaving would have been processed without anyone noticing. This is not intimacy. The bank still doesn't know your name in any meaningful sense, but it is the beginning of something that matters more than intimacy in this system. It is the beginning of leverage, and leverage, at every level above this one, is the only currency that actually counts. Level 5. High savings and assets. Your combined assets are north of $150,000. Savings, investments, and the early stages of a retirement account that's growing faster than you expected. Because you started earlier than most people do, and time in the market is the one advantage that can't be bought retroactively. You are not rich by the standard of what comes later in this conversation, but you are now in the top tier of what most retail banks encounter on any given day. And the treatment has shifted in ways that are subtle at first, then impossible to ignore. The phone line is different. There's a priority queue at your asset level. Hold times are shorter. The person who picks up is more senior, not a script reader, someone with actual authority. They can waive fees on the spot. They can make exceptions without asking permission. They can approve things that would have required 3 transfers and a callback at level 2. When something goes wrong, and something always eventually goes wrong, the resolution is faster, cleaner, and more complete. Not because the bank suddenly cares about you as a person, but because the person handling your call has the tools to actually fix it, and the incentive to make sure you stay. A dedicated banker sometimes gets assigned. Not at every institution, not automatically, but at the better banks, at this asset level, a name appears. Someone who knows your account, reaches out directly, checks in occasionally. It feels like a relationship, and in certain practical ways, it is one. But here's what you should understand about that relationship. They are attentive because their performance metrics include the retention of accounts at your level. Their bonus, in part, depends on whether you stay. Knowing that doesn't make the access less real. The exceptions they can make are genuine. The calls get returned, the problems get solved. The motivation behind the attention doesn't change what the attention actually delivers. Use it accordingly. The pre-approved offers change in character entirely. Mortgage pre-qualification, premium investment products, credit cards with actual rewards, not the 1% cashback that lower-tier cards quietly offer while advertising generosity. Travel credits, lounge access, purchase protection, concierge services. These are the products the bank was always holding in reserve, waiting until your profile justified offering them. The institution is no longer just servicing your current balance. It is thinking about what you might become, what your income trajectory looks like, what your borrowing needs will be in 5 years, what your investable assets could grow into. They are pricing their offerings against your future, not just your present. You are a preferred client now, named, flagged in the system, identified as someone worth protecting, worth competing for, worth picking up the phone for before it rings a second time. And here's the thing that should stay with you as you listen to what comes next. Nothing about you fundamentally changed. You didn't become more trustworthy. You didn't become more responsible. You didn't become more deserving of attentive service and real financial tools. Your number changed. In the entire apparatus, the hold times, the fee waivers, the named contact, the pre-approvals, Every single piece of it reorganized itself around that number. The system was always capable of treating people this way. It just chose not to, until the math said otherwise. Level 6, high net worth. The exact definition varies by institution, but it generally begins somewhere between $500,000 and $1 million in investable assets. Not total wealth, investable assets, liquid, deployable, the kind of money the bank can actually work with. At this level, something fundamental changes. The bank stops being a place you go. It becomes a service that comes to you. Wealth management gets offered. This is the packaged version of everything the financial system can do for a person: investment advisory, financial planning, tax coordination, estate guidance, wrapped into a single relationship with a single point of contact. The quality varies. Some of these advisors are exceptional, genuinely skilled, genuinely aligned with your interests, worth every basis point of the fee. Others are expensive salespeople in good suits who have learned to ask thoughtful questions before steering you toward whatever product their firm needs to move this quarter. You learn to tell the difference quickly, because the difference, compounded over years, costs a significant amount of money. The conversations change texture entirely. No one is pitching you a credit card. No one is explaining how the mobile app works. Someone is sitting across from you, or on a call that was scheduled in advance, not made to a hold queue, asking about your goals, your timeline, your risk tolerance, your family structure, whether you have a will, whether your beneficiaries are current. The bank is trying to understand your complete financial picture, not out of genuine curiosity, not out of care, but because a complete picture allows them to offer a broader range of products and capture more of your financial life inside their ecosystem. The motivation is entirely commercial. The experience feels genuinely personalized. Both of those things are true simultaneously, and understanding that tension is what separates clients who benefit from this level from clients who get quietly extracted from it. Loan approvals move at a different speed. The paperwork is lighter, the rates are better, meaningfully better, not marginally. When you need a large wire transferred, it moves. When a fraud alert freezes an account you need access to immediately, the problem gets resolved in the same conversation. No callbacks, no escalations. No reading from a script. Someone with actual authority handles it in real time, because your account warrants that level of response. And because the cost of losing you is large enough that fixing your problem immediately is simply the more rational business decision. You're not a customer at this level. The internal language has shifted. The protocols have shifted. You are an asset to the institution, something to be managed, protected, retained, and grown. The distinction matters because assets get treated with a different set of priorities than customers do. Customers are served, assets are cultivated. And here's what that means practically. The bank is now thinking about your children, your estate, the business you might start, the real estate you might acquire, the next generation of your family's relationship with capital. They are playing a longer game with you because the longer game is more profitable. The distance between this level and level 2 is not a matter of better customer service. It is not an upgraded version of the same experience. It is a categorically different institution operating inside the same building, under the same logo, with the same name on the door. The person at level 2 and the person at level 6 are both technically customers of the same bank, but they are not receiving the same product. They are not operating under the same rules. They do not have access to the same tools, the same rates, the same response times, or the same conversations. One is being processed, the other is being served. The building looks identical from the outside. What happens inside it could not be more different. Level 7. Very high net worth. Above $5 million in assets, something changes that most people never find out about, because it was never meant to be found out about. The bank begins offering things that are not advertised, not on the website, not in any brochure, not posted on any board in any branch. Products that exist in a layer of the financial system that is functionally invisible to anyone who hasn't crossed the threshold to access it. The investments available to you at this level require accredited investor status, minimum commitments in the hundreds of thousands, or a relationship history that takes years to establish. Private equity, hedge fund allocations, structured products, engineered specifically for large concentrations of capital. These are not better versions of the things retail customers can buy. They are different instruments entirely, built for a different class of capital, with different risk profiles, different return structures, and different rules. The mortgage rate on your home is lower than anything offered at level 3, not marginally, meaningfully. By enough, over the life of a 30-year loan, to amount to tens of thousands of dollars in pure difference. The bank competes aggressively for that mortgage, not because of the mortgage itself, but because a borrower at your profile brings an entire ecosystem of ancillary business they want to capture and keep. Your advisor is no longer a generalist. You have a team, one person managing investment allocation, one handling tax strategy and coordination with your accountants, one focused on estate planning, trust structures, and intergenerational wealth transfer. They talk to each other. They coordinate before they talk to you. They come to the quarterly meeting having already aligned on what to recommend and why. The meeting happens in a room that does not look like the room where level 2 customers wait. The chairs are different. The light is different. There's no number being called. No one is filling out a form on a clipboard. The conversation has different stakes, and everyone in the room knows it. You get special treatment at this level. That phrase sounds simple. What it actually describes is structural. The rules that govern retail banking, the minimums, the waiting periods, the approval timelines, the fee structures, the access restrictions. These rules apply differently to you, not because the laws changed, the laws are the same, but the bank's internal policies have discretion engineered into them, and that discretion gets exercised in favor of accounts that generate significant revenue. A fee waiver that a level 2 customer has to beg for, argue about, and sometimes still not receive, gets applied to your account automatically, without a conversation, without a request, without you ever knowing it was almost charged. An approval that takes 48 hours for someone at level 3 takes one phone call for you. The underwriter is different. The criteria are applied differently. The outcome is faster and more favorable, not because you filled out a better application, but because of the number attached to your name in the system. This is the part that most people find uncomfortable to say out loud. The financial system does not treat all customers equally. It was not designed to. The tiering is not a bug or an oversight. It is the architecture. It is the intentional, deliberate, rationally constructed logic of an industry that allocates its best resources to its most profitable relationships. Understanding that is not a reason for outrage. It is a reason for clarity. The system has rules, but the rules have exceptions, and the exceptions are not random. They flow in one direction, toward the accounts that least need them and away from the accounts that most do. At level 7, you are inside the exception, and from inside it, the system looks completely different than it does from the outside. Level 8, ultra wealthy. Private banking is a different product from wealth management in the same way a private charter is a different product from first class. They both get you to the destination. The experience is not comparable. The access is not comparable. The people involved are not comparable. At this level, you do not have a banker. You have a private banker. And that title carries a specific, operational meaning inside the institution. This person manages a small number of relationships, sometimes fewer than 20. Their entire professional existence, their calendar, their performance review, their career trajectory is organized around those relationships, not around a portfolio of hundreds of accounts processed through a system. Around 20 people, maybe fewer. They know your children's names. They know about the foundation. They know which assets you're trying to grow, which ones you're trying to protect, and which ones you're planning to transfer to the next generation, and on what timeline. They know because their job is to know, because knowing is what justifies the cost of having them. And they have direct access to the decision makers inside the institution, not through an escalation process, directly, by name, by phone, in real time. The deals at this level are bespoke. That word gets used loosely. Here it is literal. The interest rate on your loan is not published anywhere. It is negotiated. The investment minimum for a private equity co-investment is waived because the relationship justifies the exception. The documentation required for a transaction that would take a retail customer 2 weeks to assemble gets handled internally in 48 hours because the people processing it have been told whose account this is, and that information changes how they prioritize their morning. The rules become flexible. That sentence requires precision about what it means and what it doesn't. Banks do not break laws for wealthy clients. What they do is exercise every legal degree of discretion available under their internal policies, fully, aggressively, and without being asked, in favor of clients whose relationships are worth protecting. A fee that technically applies gets waived before you see it. An exception that normally requires manager approval gets approved before the manager is formally consulted. A hold that would freeze a retail account for 5 business days doesn't appear on yours at all because someone upstream made a judgment call about whose account this is. The system that was automated and indifferent at level 1, that assessed fees without knowing your name, that declined your card without knowing your situation, that processed you like a number because that is all you were, that system is now human, attentive, proactive, and structurally oriented toward yes. You are not a client at this level. You are a relationship. A named, protected, carefully managed relationship that appears as a line item in someone's performance review. Losing you would have consequences, real, career-affecting consequences, for people whose professional identity is built around not losing you. That is a different kind of power than anything else discussed in this conversation. Not the power of a good credit score, not the power of a high balance, the power of being someone that the institution itself is afraid to disappoint. Think about what that means. At level 1, the bank didn't know you existed. The system processed your overdraft and moved on. At level 8, senior people inside that same institution wake up thinking about how to keep you satisfied. Same bank, same building, same logo on the door. The distance between those two experiences is not measured in dollars. It is measured in whose interests the entire apparatus is designed to serve. And at every level of the system, that answer has always been the same. It was never a secret. It was just never said out loud.